Hi, my name is Rob Moore. I'm one of the proud partners here at Center for Wealth Management. I'm a certified financial planner, been helping people for over 20 years reach their financial goals. And one of the main problems or hurdles that they have to reaching their goals, that's paying too much in taxes. The investment strategy that I'm going to refer to today is going to help people reduce their overall tax liability, giving them a better chance at a higher after-tax rate of return. Most people will invest in traditional mutual funds or ETF, which is an exchange-traded fund. And nothing's necessarily wrong with those. However, they can come with additional tax burdens. For example, if you buy a mutual fund is a pool of individual stocks, and there is a team of people who are buying and selling those stocks on your behalf. Now, as they buy and sell these stocks, because it is a non-retirement account, that will trigger some taxes, either good or bad. You have no control over that. So the net rate of return is always going to be lower than the initial rate of return. Now with an ETF, they are typically a passive investment, so there's not necessarily somebody buying and selling things and triggering taxes. One issue that we see that's common with ETFs is that if you hold on to them for more than 5 years, you're going to have a profit in them typically. If you have a profit in them, let's say that you invested $100,000 in one ETF and now it's worth $200,000. Well, if you go to sell that ETF, you're going to pay taxes on the profits. What we notice with people is that becomes a hindrance for them to actually sell that ETF. Well, what if they want to re-diversify or rebalance their portfolio? They might not want to trigger that tax, so they might not diversify properly. What if they need to raise some capital? Again, they might not sell that one just because they don't want to pay that tax liability. So for those reasons, people tend to hang on to ETFs and mutual funds longer than they ought to, simply because they're trying to avoid paying taxes on their gains. Now, what's different with direct indexing is that instead of owning the pool or the fund that owns all those stocks, you are actually going to own all those individual stocks. And that gives you the power. So the team that's professionally managing all those individual stocks, they're going to decide when to buy and sell things. So you are going to have a lot better control over the taxation of that. The team that we have running this actually is going to be looking at your portfolio on a daily basis. And they're going to be looking to do what's called tax loss harvesting. So if you have a stock that is down, they may look to sell that stock. Let me give you one example. Let's say that Walmart had a bad earnings report and subsequently their stock went down in price. Well, they might sell that stock at a loss, and now that loss goes in a pool, and you get to either use that pool of losses to go against future capital gains that you trigger, or you could actually, the IRS allows you to write off $3,000 of losses each year. So you could write off some of those losses against other income. Did you know that in 2023, the Russell 3000 made a 26% rate of return overall? Now, inside the Russell 3000, there's about 2,700 stocks. What you may not know is that of those 2,700 stocks, about 1,100 of them were actually negative, and they lost money in 2023. So the remaining group is what really got the 26% rate of return plus to make up for what those 1,100 stocks lost. And that's the power of direct indexing. Throughout the year, there are going to be some stocks that are at a loss. And so when we take a look at your portfolio daily, we'll be able to harvest some of those losses, put them in a pool, set them aside to go against future capital gains. Now, going back to my example, let's say that Walmart was down and you sell it, so now it's sitting in cash. But do you just want to leave that there in cash? Well, most likely no, you want to reinvest it. The IRS does not let you reinvest in Walmart for 30 more days though. So you would typically want to find a substitute. In this case, let's say that you bought Costco. Something that's in the same field would have typically a similar rate of return as maybe what Walmart might. The bottom line is with direct indexing, you're going to have greater control over your taxes because you get to hold and sell all of the different individual pieces yourselves. When we look at the math on this, some of our clients with direct indexing can have a higher after-tax rate of return than they would with traditional fund investing. Let me give you an example. Let's say with a traditional fund investing style, you have a 12% rate of return. Best case scenario, no taxes, and you still end up after tax with a 12% rate of return. Another situation might be we have a 12% rate of return, but we do have to pay some taxes on it. Let's say it's 0.5% in cost. And so you net 11.5% rate of return. With direct indexing though, let's say that we wrote off $3,000 of losses, which is the most that the IRS will let you do in 1 year because of all the tax loss harvesting that was done daily in the portfolio. So now we have a 12% rate of return, and let's say that we got 0.5% of tax write-offs, and so now our after-tax rate of return was 12.5% back to the portfolio. Now, direct indexing typically won't actually hold all of the individual stocks that are in the S&P 500, for example. They might own 300 stocks instead. So the rate of return on it won't be exact. The difference between the S&P 500's rate of return and the direct indexing portfolio's rate of return is called tracking error. And that tracking error could be positive or negative. We typically see it between 1 and 2.5%. So that is something to be aware of with this strategy. Now, one more major benefit with this portfolio again is yours, and no one else is going to have another portfolio that looks like this. And with that comes the ability to tailor it. So there are some clients that give us some instruction that they don't want to own certain stocks. Maybe they don't like a certain company that sells cigarettes, so they want to avoid that company altogether. They might want to avoid an entire industry. Maybe they work for a utility company, and so they have plenty of utility stock exposure, and so they want to avoid that industry completely. That's something that we can tailor inside this direct indexing. So as you can see, direct indexing is a really powerful strategy that allows you to take control of your tax liability compared to traditional fund investing. And it also allows you to tailor the portfolio to your preferences. So who benefits from direct indexing? It's those that are typically trying to avoid capital gains, but more importantly, those that are in already high tax brackets, those that are trying to avoid having more income on their tax return because they pay a higher tax rate. And direct indexing is just another strategy that we use to enhance your rate of return. Your portfolio will have a rate of return, and we hope it's great, but we're also hoping to add value by helping you keep more money in your pocket through different tax strategies like direct indexing. Now, there's more to say about direct indexing, and so I'd love the opportunity to explain it a little bit more. But this is just an introduction for today. I hope it was helpful, and I hope you have a great day. I look forward to hearing from you again soon.